Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for August 1st, 2015. The market is in bullish quiet condition. On an annual basis, using weekly RSI 14, we are just above the halfway point in neutral at 55 out of 100. Shorter term, using the 10-day NDX, we're still in neutral conditions at 61 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is 2.47% above. That's red bullish, meaning we have about a 0.5% cushion between bullish and sideways conditions. The slope of the 50 moving average has dipped slightly negative at minus 0.08%, rating of neutral, yellow neutral. ADX is still a non-trending 14.5. The risk index is the 30-period moving average of the VIX divided by the 10-period. That threshold between risk on and risk off is 1.0. The current reading's at 1.11. That puts us into risk on. We take that score, compare it to the last 5,000 trading days, take the average and standard deviation, lets us compute the risk Z-score, which is at 1.33. You can see a 90-day time series of that indicator is a histogram. We got up to about 1.7 Z-score and have been decaying slightly here, so this is a place where we want to make sure that our swing trade stops are in place. We still have a long side bias, but because of the extreme move, we are preparing for more volatility in the future. The blended monthly rebalancing, you can see the new current holdings. Next reevaluation is going to be on or about 1 September. Either made this one at the end of last week or first thing Monday. In ETF2, the theoretical exposure of the model is at 30%. The model portfolio is at 80% exposed with the stops in place. Here's just a quick look at the blended monthly rebalancing portfolios. You'll see dominated still by cash positions, but with the losses of the last couple of months. In ETF Max, some things to note. The biotechs are very strong across the board. Some money came into Ireland and Denmark this week, along with home construction and consumer staples. Interesting plays. Home builders, mid-cap 400 growth. So there's some interesting areas to play there. This is the S&P 500 through the same BMR lens. Netflix and Cablevision continue to dominate. Those are outstanding intraday targets as well because of that relative strength. Royal Caribbean and Sealed Air Corporations both had remarkable weeks. So we'll be looking for momentum plays there. Total Systems and Reynolds. D.R. Horton is on my short list here, DHI, with an 11% gain this week. Mondelez and then Brown-Forman and Mohawk Industries. So there's some real potentials in there. Cigna had been and still is an exceptional outperformer long term, but has suffered here in the last week and a month, and so there may be some opportunities for rebounds or a collapse of that exceptional performance. So momentum plays look like they abound right now. In ETF2, again, 3 of the 10 symbols are on buy signals, 7 are on cash. That puts us at 30 and 70. The in the global rating, S&P at 67 is better than the globals at 65. Inside the U.S., it's technology at 72, small cap 68, large cap 67, and mid caps trailing at 66. We have real strength right now in financials, healthcare, and consumer discretionary. The U.S. is all above average, looking at the world market model, with exceptional performance here on the growth side. Europe is all above average, and Belgium. Japan is above average, but now China has slipped back underneath the database average. Only India and Vietnam showing strength in Asia. Mexico is marching pretty well. Brazil and Latin America itself still broadly suffering. ETF 30 review, looking at the top 30 using the ETF2 lens, still dominated by financials and biotech. Italy is still here at the top of the stack. Consumer discretionary and financials, XLY and XLF respectively, are new to the game and should continue to reward us. You can see the home builders coming in looking strong as well. Natural gas is white then yellow, so it's still climbing that ladder of success. This is the Dow 30 using that ETF2 lens, still dominated by the financials with Goldman, Morgan, and Visa in 3 of the top 5, with Disney and Nike rounding out the top 5. Home Depot, green and white, still looking strong. United Health starting to slip with white and yellow. Travelers moving up the stack here with yellow, or with white and yellow, along with Procter & Gamble, also white and yellow. DuPont still lagging at the bottom, has been a decent intraday play, however, on rebounds. We'll shift to the daily report. No signals for channeling or overreaction. Got a ton that test out well on the auto framer using a 2-to-1 standard. Here's Apple on a channeling and an overreaction. Number 4 in the max pain range compression, testing out at 5-to-1. It would not surprise me to see a strong move in Apple on buy-on dips in that area. Just a couple frog candidates here, and then 2 on the RSI2 trigger with Apple and Procter & Gamble. Inside the ETFs, utilities and treasuries signaling overreaction signals on the short side. We have a 5DD in the VIX. There's one-day short pop here in Latin America and emerging markets. Again, only a couple test out on the fraud quality number, and then DBC is the only RSI2 signal. So not as much to choose from in here, but I think there are some interesting setups when you look at the auto framer independent of the patterns. Here's the auto framers with all the technical data you need to frame your trades. In the RLFF framework, the ones in the green are the value plays, the ones that are the most ATRs below their own 270 regression line. So the value plays in DuPont, United Tech, Walmart, 3M, and Alcoa. And these are the relative strength leaders, the most numbers of ATR above their own 270 regression line: Nike, Disney, Visa, Morgan, and AT&T. So a lot to choose from depending on which side of the curve you like to trade. Many good quality squeezes here. These are symbols that have become squeezed on a daily basis, meaning that their range is less than 0.7 of their average 30-day range. And then that's this column. And then the range stat divided by my risk is we pick one of these risk measures. In most cases, it's the range risk, the one that's in the middle. And we divide that into the range stat, and if we get better than 2-to-1, this is something that has been squeezed, and yet if we just take a mechanical trade, is offered a favorable reward to risk simply using the daily mechanical entries. So a lot of good ones to choose from here. Notice DuPont, Google, the inverse volatility, Schlumberger, lots of good ones to choose from. And that's everything I want to cover. I'll just flash through the rest of the charts here for your references. What I like about this reading here on the z-scores of the regression line slopes, they're all pointing up, so you have the 90 has pulled back to the 180-day average. The 10 is oscillated but has higher lows, and the 30 has dipped back up and is now crossing higher. So this is actually kind of a lazy W buy on dip opportunity. If we get any kind of momentum, we should be able to get through 212 on this next push. So this feels favorable after almost 6 months of just sideways chop. This has been tough sledding. Okay, that's everything I want to cover. Keep your wrist measured and your powder dry.